Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on building a green economy, unlocking future of sustainable finance. We sincerely appreciate you taking the time to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Anil Kumar Makkar, Chief Sustainability Officer at JK Organization. Ms. Anjalee S. Tarapore, Independent Director and ESG Practitioner. Mr. Mahendra Bisht, Managing Director of Energy Transmission Fund at EAAA Alternative. Mr. Vinay Sekar, Chief Executive Officer at Cube Highways Trust. This session will be moderated by Ms. Swati Agrawal, Co-CEO and President at CareEdge Analytics and Advisory. We will commence the session with a presentation by Mr. Kedar Deshpande, Director of ESG at CareEdge Advisory. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Kedar to make the presentation.
Thank you. Thank you, Mamta. Good evening, everyone. Climate change and sustainable finance are no longer new buzzwords in the market. In fact, these are the core topics, part of every business strategies, and many of the decisions are revolving around these areas. Indian government has committed to net zero by 2070, and to achieve this target, ministries and regulations are working in developing policies and frameworks to develop ecosystem around the sustainable finance. We are also witnessing significant influx of domestic and international investors in the Indian market, searching for opportunities aligning with E, S, and G principles. Keeping this background, today's presentation is focused around following topics. Background about climate change, its significance and impact. Development of regulations in Indian market as well as in major international markets. Role of climate finance, mitigation and adaptation finance and sources of finance. Climate finance instruments covering various available sustainable finance instruments, their trends and key highlights. Challenges in raising sustainable finance faced by market participants, both from issuer and investor side. And lastly, way forward, highlighting key opportunities lie ahead and the proposed steps. Moving on to climate change, economic impact, and the global risk. Every year, World Economic Forum releases report on global risk perceived by experts across academia, business, government, international organization, and civil society. As you can see on the left-hand side of the slide, out of top 10 risks perceived by these experts, 5 risks are dominated by climate change and extreme events. On the right-hand side, we can see the impact these climate events have caused on global and Indian economy. In 2023 alone, global economic losses from climate disasters are pegged at $380 billion. For India specific, impact is estimated to be in the range of 2.8% of our GDP, plus India could account more than 40% of global job losses from the heat stress associated productivity decline by 2030. These numbers clearly exemplify criticality of climate change and its impact on us. These impacts are being felt by all of us every day and thus call for the action. Moving towards regulatory actions that have taken place in the global markets. EU has always been on front running in giving directions and taking bold steps on tackling climate change. Fit for 55 policy is adopted with a target of reducing GHG emissions by at least 55% by 2030. Moreover, they have taken various measures to this effect, such as strengthening emission trading system, introducing carbon border tax mechanism, setting up social climate fund, and many more. In Asia also, we see Singapore and Japanese market exhibits equally aggressive steps, such as net zero by 2050. Singapore has established separate green bond framework with a target to raise over $35 billion by 2030, while Japan has set up $15 billion innovation fund for clean energy projects. Similarly, we see the action stemming up from the Middle East region as well. Talking about India-specific steps, commitment towards NDCs and developing responsible business conduct principles in the form of NGRBC have taken place between 2015 to 2020. However, we see significant traction happening post 2020 when the regulations started becoming a lot more comprehensive and mandated as well. In 21, SEBI introduced green debt securities regulations, providing much needed clarity on eligible activities qualified as green. Further, Government of India introduced Sovereign Green Bond Framework, which provides an overarching framework which aligns with internationally recognized frameworks such as ICMA. In 2023, RBI introduced green deposits and governance mechanism around it, and subsequently in 2024, it introduced climate-related disclosure guidelines for banks and NBFCs. Most recently, Ministry of Steel introduced Green Steel Taxonomy, the first taxonomy in India, which clearly defines what is green steel. This was much needed one for the industry which has been in the eye of storm for demand to reduce its emission by its investors and customers. Further, industry is awaiting for the introduction of India Carbon Credit Trading Scheme, expected to be introduced in 2026. Like ESG disclosure standards that have evolved globally, similarly, there are global frameworks and regulations which are referred to while developing the sustainable finance framework. GSS bonds and loans are typically based on principles developed by global organizations like ICMA, Climate Bond Initiatives, and Loan Market Association. Moreover, SEBI in its NCS regulations for green securities also provides clarity on activities which can be considered as green. Most of these activities, which you can see it on the right side of your screen, overlap with the global framework as well. Additionally, while issuing green securities under SEBI NCS regulations, issuer is also expected to fulfill various disclosure requirements which are specified in the regulations. These disclosure requirements is a step towards building transparency and accountability on the issuer side by building robust governance around the issuance process. Now, moving towards India's climate investments, which are largely divided under two buckets: mitigation and adaptation. Mitigation investments primarily revolve around clean energy, clean transportation, and energy efficiency related activities, while adaptation investments are focused on greater and long term issues like disaster monitoring, flood mitigation, drought management, etc. If you see the past data on investments in these areas, there is active participation of private investments in mitigation areas, while almost nil participation in adaptation areas, which is largely dominated by the public funding sources. Mainly central and state government budgets accounted for over 98% of finance needs in the adaptation areas. As far as international funding is concerned, it is largely focused on the mitigation measures. Let me just pause here for a couple of seconds for the audience to gauge this data. Okay, let me move on. Now, moving towards investment tools and instruments, to fund these climate and sustainable objectives, we have multiple investment instruments such as green, social, and sustainable bonds, which is popularly known as GSS bonds, green loans, sustainability linked loans, and ESG mutual funds. Each instrument carries their own specific criteria, characteristics, and the trends that we'll be covering in the subsequent slides. If we analyze trends in GSS bonds, volume of India's GSS bond market is still very low compared to developed markets like France and US, as well as emerging markets like China. However, the growth of these bonds have picked up significantly in 2023 and exhibiting a CAGR of over 40% over the last 5 years, which is quite encouraging sign for the market. This also shows gradually Indian market is moving towards more specialized instrument to fund its sustainable goals. In this journey, particularly the green bond dominates volume in the market. And if you clearly notice, type of the issuers who have entered in this market is not just limited to corporate and financial institutions, but municipal bodies like Ahmedabad, Vadodara, Ghaziabad Municipal Corporation have also issued green bond to fund green and sustainable development goals for their cities. Further, we are noticing traction is getting built up in the sector which traditionally being looked at non-green assets like road and infrastructure. NHAI last year issued green bond to support its green activities on Delhi Mumbai Expressway. On green loans, currently most of the funding is sourced from the international development institutions like IFC, ADB, AFD, and many more. Most of these loans are raised by large financial institutions from these development institutions to fund specific green activity such as solar rooftop, green affordable housing, green loans to MSMEs, etc. Moving on to sustainability linked loans and bonds. These instruments typically cover specific KPIs and targets that issuer needs to agree to achieve against defined time period. This gives better monitoring and control in the hands of investor and lender, given these instruments are tied up against measurable outcome. At the same time, it brings lot of governance and monitoring aspect from issuer and borrower side. Basis data collected by CareEdge, we notice in the last 4 years there has been steady flow of sustainability linked loans instruments in India. In fact, there is noticeable jump in these instruments in 2024. Moreover, we see demand for these instruments coming from the financial institutions as well as from the corporate side as well. Similarly, on sustainability linked bond issuance, interesting point to note is these issuances are coming from hard to abate sectors that are expected to play a major role in India's net zero journey. We are seeing these issuances coming from sectors like infrastructure, steel, cement, and utility sectors. Now, moving on to ESG mutual funds, which are still gaining the momentum while SEBI has created a strong regulations around it. While the first mutual fund, ESG mutual fund introduced in India around 2018-2019, but quickly this market is expanded and today we have 10 asset managers who have various ESG thematic funds operating in India. As of December 2024, AUM of ESG funds stands at 1.14 billion US dollars, which is still minuscule compared to the total AUM market for India. Moving on to, so far we have seen about regulations, growth, and instruments about sustainable finance. Basis the data shown in the previous slide, we notice volume of such instruments have not picked up the way it is in other developed and emerging markets. So this brings us to the topic of gaps in sustainable finance and challenges associated with it. To meet NDCs, it is estimated that India needs investment to the tune of rupees 162 trillion rupees or annually 11 trillion rupees. If you take a look at the data in below graph, since the time India committed to NDC till 2021, financing received in each year is significantly lower than the amount required. The highest investment occurred in 2021, rupees 4.3 trillion rupees, is not even 50% of the annual requirement of rupees 11 trillion rupees. Talking about the challenges, topmost issue that investors and issuers are facing is the greenium associated with these securities. At least for the Indian market, the market participants still finding it hard to get the greenium, and that is the first bottleneck they face when comparing against the traditional means of finances. Secondly, having clarity on what is green is the most crucial part of the financial institution, issuers, and investors to identify right opportunities and activities to finance. While many developed and emerging economies have come up with their green taxonomy, however, India is still awaiting its green taxonomy. Third, the high compliance cost. Typically, sustainable finance instruments require high level of governance, monitoring, and reporting requirements, which can become cumbersome or challenging for small and mid-market players. This makes them to adopt more cautious approach before going for such funding route. As need for sustainable finance is critical for the country to meet its NDC, but at the same time, market forces require incentivization from the government and regulatory authorities for participating in such instrument. such as tax benefit for investors, lower risk weightage for the green assets, or reduction in CRR requirement for financial institutions, to name a few. However, currently no such incentives being provided by authorities, which makes this instrument less lucrative. Lastly, banks and institutions need to have mature business model so that these green projects become commercially viable to attract the required funding. While talking about the way forward, first let's take a look at the emerging areas and technologies, which is beyond EV and the renewable sectors. Sorry. The areas identified, such as green hydrogen, carbon capture, and energy storage, are some of the upcoming and having high potential of growth given the applications of these activities across industry. It is important that sustainable finance should also get diversified beyond EV and renewable sources. Lastly, to capture these opportunities, we believe below four elements are going to play a crucial role. First, awareness about instruments, the frameworks, processes, and benefits associated with it. Secondly, participation of private investment, especially under the adaptation finance, can help in advancing or meeting the desired goals in a time bound manner. Third, role of venture finance to promote technologies and activities which are towards mitigating climate change but yet prove commercially. To develop this ecosystem and provide early seed funding, role of venture capitals is going to be crucial. Lastly, regulatory support on taxonomy and government incentivization can only help to boost sustainable finance in our country. This brings to an end to our presentation. Now I hand over to Mamta to take forward the agenda.
Thank you, Kedar. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Ms. Swati Agrawal to take over the session, please? With 30 years of diverse expertise in areas of credit analysis, market development, and business strategy, Ms. Swati Agrawal has been associated with CareEdge Group since 2003 and is currently serving as the CEO and President at CareEdge Analytics and Advisory. Prior to her current role, she was serving as Senior Director with CareEdge Ratings, where she was instrumental in developing and growing the franchise, especially in the North, South, and East markets. Ms. Agrawal is a regular speaker at various industry forums and seminars. She holds an MBA from SB Jain Institute of Management and an engineering degree from GB Pant College of Engineering. Over to you, Swati.
Sorry. Thank you, Mamta, for the introduction. And thank you, Kedar, for the presentation. Clearly, from the presentation, we see two, three things coming out. One, of course, the role or the climate risk is real, and it has the potential to shave 3 to 10% of the country's GDP in years to come. Number two is while there are funds and there is a kind of instruments available, but it's still quite short. In fact, one third of what is the requirement. While the country probably requires about 11 trillion rupees on a yearly basis, just for the mitigation, the availability of such funds is only about one third. And clearly, we can see in the adaptation sector, the private sector participation is very missing, and it's mostly being funded by the government budgetary support. Further, there are challenges, and most of the time, you see the sustainable funds actually, promoting the clean energy or the clean transportation or the energy efficiency sectors, whereas there are other avenues. So, to discuss some of these issues, we have this panel with us, and as I will be introducing the panel, and we can see that we have a couple of borrowers on the panel as well as a couple of lenders on the panel. So let's look at some kind of interesting discussion going forward. Let me just very quickly introduce the panel. Our number one speaker is Mr. Anil Makkar. He is the Chief Sustainability Officer at JK Organization, and he's a seasoned professional with an illustrious career spanning multiple continents. With over 45 years of experience in the industry, he has accumulated extensive knowledge in tire manufacturing. His leadership, commitment to sustainability, and innovative thinking has not only elevated JK Tyre's manufacturing practices, but has also made a significant impact on the industry as a whole. He has received prestigious awards such as PMA, Energy Efficiency, and Water Conservation Awards. And in his currently capacity, he oversees the sustainability operations for the entire JK organizations. Welcome to our webinar, Mr. Makkar. Our second panelist is Anjalee Tarapore. Anjalee is an independent director, macroeconomist, and an ESG practitioner. Prior to this, she was the executive vice president and head ESG at HDFC Bank. And she has spent over 27 years in HDFC Group with specialization in investor relations, ESG, financial analysis, early stage debt, and impact based lending and treasury functions. She has assisted high level committees constituted by the Government of India on Housing and Infrastructure and has also been a member of the G20 Working Group on Financial Inclusion and Business Acceleration. A warm welcome to you, Anjalee. Our third panelist is Mr. Mahendra Bisht. He is the managing director with EAAA Alternatives. And with this, he leads the firm's energy transition focused fund. Mahendra has over 22 years of experience in investments and advisory, primarily focused on the Indian infrastructure sector, with specialized focused on renewable energy. Earlier, Mahendra had worked with Global Infrastructure Partners India, IDFC Alternatives, KPMG, and CRISIL. And he holds an MBA from IIM Bangalore and a bachelor's degree from University of Delhi. A very warm welcome to you too, Mahendra, to join our panel. And lastly, I introduce Mr. Vinay Sekar. He's the CEO of Cube Highways Trust and is a seasoned leader with extensive experience in infrastructure investments and asset management. With a BTech in Mechanical Engineering from IIT Madras and a PGTM from IIM Ahmedabad, he has held key roles at Cube Highways, IndusInd Bank, and IFCI Limited. At Cube Highways Trust, he plays a pivotal role in driving sustainable infrastructure development, leveraging innovative financing, and strategic asset management to enhance long-term value. His expertise in transportation and highway asset contributes to building resilient, future-ready infrastructure with a strong emphasis on sustainability and operational efficiency. Very warm welcome to you too, Vinay. I'll now straight away move into the questions. And my first question is for Vinay. Vinay, Cube Highways has recently raised sustainability-linked bonds for rupees 860 odd crores. And could you, for the benefit of all of us, could you tell us about the key drivers and how was this choice of instrument made? What really were the decision-making factors, and what are the clear advantages that this means of finance could bring to the issue?
Sure. Thanks, Swati, and thanks to the CareEdge team for hosting me here. I think so. I think the sustainability-linked bond we had issued was subscribed by IFC. IFC and Cube have been long-term partners. They've invested in us for over 10 years now. And I think this is essentially a culmination of some of the things that we've done with IFC over the last 10 years, right? Sustainable practices have always been a part of our business model right from the beginning, whether given the parentage that we had with IFC being there. We've worked on various aspects of transportation to make it sustainable. I think obviously whether it's on the energy side where you have solar energy used or you use electric vehicles in your roads, or most importantly in being able to use sustainable materials when you have to construct or maintain roads, whether it's recycling, whether it is new technologies to make it more efficient in terms of the amount of new virgin material that you use. So these practices have always been a part of our business. I think over the last 2-3 years, we've spent time to really map out how we measure our impact. So I think that was a step that we'd taken a few years back. And we started measuring our scope 1, scope 2, scope 3 GHG emissions when we looked at various other things, how we are contributing when we do our some of our major maintenance works, and if we recycle material and things like that. So we'd already taken all of these steps, and therefore this seemed like a natural progression for us in terms of the partnership with IFC, in order to be able to create something in this sector. It's I think to be able to demonstrate that we could sort of do something like this. So I think. I think so. The reasons for doing this is not purely commercial. It's also to sort of be able to set that benchmark for the industry, to be able to demonstrate the capabilities that we've built on the technical side, to be able to deliver on some of these KPIs. And on the sort of flip side, we have again IFC as a partner. They provide flexible financing, long-term financing, which works for us. Uh, uh, they provide financing at rates which are sort of market based, so it's not off market at least. And I think it's very competitive in terms of where other issuances take place. So I think Kedar spoke about a green EM. I don't think that exists today, but at least we are aligned to the market. And it's a long-term financing. It's an FPI financing, which means that there is more flexibility in terms of end use. We can use it for acquisitions, etc. So I think as a package, therefore, it related to the business model that we've anyways been practicing. It puts out our abilities in a sort of formal way, and it diversifies the sources of our financing. So I think these were the strategic reasons for us to sort of jump into this and get this bond done.
Very interesting. I mean, number one, you spoke about how, as an infrastructure entity, sustainability has been high. And number two, you spoke about how this integrates with the lender's perspective or the lender's, um, a pocket in terms of lending, the sustainable loans, and of course the flexibility attached to the loan. So that's an interesting viewpoint.
Yeah.
Let's hear Mr. Makkar on this, because he's also another borrower. And Mr. Makkar, you've been heading the sustainability practice for the entire JK Group, and JK Group is a client of ours, and we are aware that how serious all those companies are in terms of the ESG practices and the metrics that's raised out. And recently, JK Tyre also raised a 100 million sustainability linked loan, and incidentally, that's also from IFC. So, could you dwell upon what have been your motives? And I also believe this is your first sustainability linked loan in the entire group. So, could you also, enlighten us on what have been your key drivers for this kind of finance, and how do you see the clear advantages? Yeah, please.
I think, first of all, good afternoon, everybody, and thanks for having us here. I think if I fully echo what Vinay had just mentioned, we are a hardcore manufacturing company. And when you talk about making tires, you definitely have a lot of greenhouse gas emissions. And we've been practicing this for quite some time. I remember very clearly that my first carbon footprinting was done way back in 2013-14. So that was our base year. And we've been working on reducing our scope 1, scope 2, scope 3 emissions to a very large extent over the last decade. And this whole subject came up just before this sustainability linked loan of 100 million. We had an equity partnership from IFC. So while we were doing that equity partnership from IFC, they went through all our performance standards, qualifying for their own internal performance requirements. And we really got a very huge compliment from IFC, saying that they wanted to teach us about sustainability, and finally they ended up learning something from us. So, which was a huge compliment for us. And then this subject came up that while we are doing so much on the sustainability part, even being in an industry which deals with carbon black, why don't we look at something which is more in terms of green money? And I am an odd man out in this panel, as I'm a hardcore manufacturing person and not a finance guy. But we did have a lot of excitement while we were working on this sustainability loan. And yes, it was very interesting to participate in that, to understand what the world is doing around on sustainability, how the financing is going to move around on this. And the benefit, obviously, like Vinay said, that yes, there are advantages in terms of the rates, pricing, and the end use flexibility. And it's an ongoing challenge for us. I mean, what we have really done, we have identified a couple of KPIs very strongly, and have linked it to the loan rates. And if we are able to achieve it, which I'm sure we will have an advantage further on whatever the pricing rates have been given. So it's kind of a challenge to us in a way that we will continue to improve our sustainability performance, and at the same time, you get finance to really expand, increase your product line, invest into green projects, and also increase capacity to make sure that you are in sync with the market requirements, market developments happening. The whole bias technology is going off, and the new riddle technology is coming in. So all that is very, very critical in terms of uh, funding requirements. So it kind of synced very well, and we look forward for having that full advantage, meeting the KPIs of sustainability, and even taking further advantages on that. And that kind of keeps us on toes and keep monitoring it. So I think I add that point and answer your question.
Yeah, maybe you could also just touch upon the greenium part. I mean, you also think that greenium is really a distance away, and probably maybe it's not really worth ask. I mean, in light of the other advantages that such dedicated
I don't think
funds.
I share the same view as when I said that not much existence at this point in time. Yeah.
Great. Okay, so I'll come back on these. It's interesting to hear these borrowers' perspective. But let me now move to the lenders, and I'll start with you, Anjali. You've been with the financial sector for a long time, and maybe you could explain to us or tell us about how financial institutions look at ESG and sustainability parameters when they evaluate lending proposals. Is it that they only look at these parameters when they're doing specific SLL or GSS loans, or do they do it on a general as part of the normal credit appraisal? And if they classify such a loan as an SLL, does the bank or the lender have any clear advantages?
Thank you so much, Swati. So what has very clearly emerged today from a lender's perspective is that any assessment of a loan requires an evaluation of the financial and non-financial parameters. Now, when one refers to the non-financial parameters, it entails various aspects of ESG, largely because financiers and the regulators are increasingly focusing on non-financial risks and operational resilience. Now, when financial institutions currently are not mandated to conduct an environmental and social due diligence, but many banks and financial institutions have voluntarily begun this process. And this, of course, would entail, doing environmental impact assessments, social impact assessments. Now, some of the banks are doing this internally as part of their credit appetite memorandum, while sometimes they may choose to outsource this ENS assessment if the expertise is not available in-house. Now, what more and more financial institutions are doing is that they are incorporating environmental and social covenants in their sanction letters as well as in their master facility agreements. One critical question is that the quality of data certainly varies across lenders, but this will improve over a period of time. So what India really needs now are ESG repositories, which can work akin to how credit bureaus work. So in future, if there is a borrower, the bank just needs to tap into this repository, extract the ESG data. It's a long way to go, but these are the kind of institutional mechanisms that we will need to build out. Just one specific point on financed emissions, because this is the most critical part of the emissions for a financial institution, forming part of its scope 3 emissions. Now, you would recall that the RBI in February 2024 came out with its second draft guidelines, especially on climate risk disclosures. And there they had indicated that banks and financial institutions would need to start reporting at least sectoral level financed emissions. Now, the problem in India is that we still do not have India-specific environmentally extended input-output models. They are being developed, but there are some good initiatives happening as well. For instance, there is IFCI and TERI have come together, joined hands to build a platform which would enable certain standardized data on financed emissions. We don't know whether this project eventually takes off in the way it is envisaged, but once there is standardized data across for banks and financial institutions, I think the rigor will substantially increase in terms of ENS due diligence. Just lastly, I totally agree with the point on the greenium really not being in existence. So when you did ask the initial question, is there a differentiation in pricing? Well, at this juncture, even though the ENS assessment is done, there really isn't a differential in pricing. But going forward, I think we're laying the path for something like this. And last point is, whenever there is, as both our earlier speakers also alluded to, when there is a capital raise or their borrowings from, say, like multilateral institutions, then the ENS assessment is absolutely non-negotiable. Thank you.
No, interesting. So I think the biggest point here is the role of, or the increasing role of non-financial data that is now coming into play from a lender's perspective. And I think the issuers, even if they want to, they can't wish away this. And of course, banks are increasingly under compliance, and like you mentioned, it's evolving more in that direction. Very interesting. Let's hear Mahendra Bisht on this. And Mahendra, Edelweiss is a large investor, and it operates through various platforms and entities. And you've recently launched an energy transition fund. Could you tell us more about this fund, the genesis, the investment philosophy, and and maybe you could also touch upon the normal returns versus the focus on sustainability projects. Do you want to do a balancing act here, or happy to hear you.
Sure. No, thanks, Swati. And first of all, thanks for inviting us to contribute to this webinar today. You're absolutely right. I think as managers of institutional capital, our experience has basically shown that while we may be managing capital which focuses exclusively on what we call sort of sustainable investments, or we can also manage capital for institutions in regular investments that we make. I think commercially there is little difference in the investor's mind. I mean, there is definitely a push to provide capital to unlock the potential for sustainable growth. But having said that, that is not at the expense of returns. So for any of the capital that we are managing, and especially for the energy transition fund, our focus is on something that we call sort of like the double bottom line, which is the impact that you're creating through the investments that you're making in these sort of climate friendly sectors, but at the same time the returns that you're able to generate for your investors, and it's no different from the investments that you make regularly. On the genesis of the fund, I think Kedar's presentation outlined the background pretty well. So there's definitely the climate context to the areas in which we intend to be active. But at the same time, beyond that, I think India has done a good job of putting together a commercial and regulatory framework, which provides sort of balanced risk reward for investors. And that has attracted a lot of institutional interest into investing in these spaces. So our fund effectively came through conversations that we have been having with our investors, who contribute capital to our other funds and who showed interest. And this is the push factor of providing sort of capital to unlock some of these climate friendly solutions. And at the same time, us actively seeing investable opportunities in India that provide attractive returns. And through a combination of this, we felt that this would be the right approach for us, and we'd be able to sort of do justice to our investors' objectives. In terms of the focus, I think we would, being sort of late stage investors, we would squarely fall into what Kedar's presentation termed, the mitigation segment of energy transition. So definitely a lot of focus on renewable energy solutions, on power transmission solutions, battery storage as well. But at the same time, also quite keen on emerging segments like EV mobility, energy efficiency, industrial decarbonization, spaces where we feel either scalable business models don't exist at the moment or are just emerging. So I think our focus would remain across these segments. We would stay away at the moment from any EPC or emerging technology based businesses, because that frankly is not within the mandate of the investor group that we represent.
Interesting. So, what I gather is that one, there is decent international capital available for sustainability related areas. Number one. Number two is, I guess it's still evolving because the bankability or the maturity level of such, would say, transition projects, or this is in various stages. So I guess, yeah, one would take a, depending on the investor appetite or the fund appetite, one would take a calibrated approach in terms of investments.
True. Just to clarify, I think there's some segments within energy transition where the commercial construct is a lot clearer. So renewables, for example, or power transmission or battery storage, it is clearer. But there are absolutely segments, like you rightly said, where it's still emerging, and clarity will emerge over the next few quarters or years.
Great. So let's come back to our issuers. I'll start with you, Vinay. So you spoke about the advantages. Now, so what I could gather is that, look, Cube was already in the sustainability process, and you had already a certain parameters, and you were working through it. Would that So let's say for a fresh issuer or a completely new issuer, could you elaborate whether he needs to be in that journey, number one, in the first place to access this kind of fund, or he can start with a clean slate? Number two is, what do you think are the operational challenges that he could face when they access these funds, and how they should be better prepared when they access this source of funds?
Yeah. So let me put it this way. I think every issuer needs to diversify its sources of funding. So at least prepare themselves to diversify their sources of funding, right? One. Number two, I think Anjali spoke about the fact that a lot of lenders of the non sort of green lenders as well are incorporating ESG clauses in their term sheets and financing. And at least my view is that the way some of this will evolve is that it is more likely that you have essentially the sustainable financing routes merge with traditional funding routes, where you essentially have clauses with respect to ESG, with respect to all of these factors merging with those parts of the capital. So I think to three, at least when we look at our business, a lot of the initiatives that we've committed to or have committed either de-risks our business or directly gives us EBITDA gains, because when, for example, recycling of material is a no-brainer for us, right? We save using new material. It's a cost saving as well, right? So I think all of these factors sort of would apply to most businesses in some way or the other, right? So you're de-risking your business, you're addressing some of your potential threats, you're reducing your costs, you're diversifying your sources of financing, and you're future-proofing your means of financing for yourself, right? So I think therefore it's prudent for people to start thinking about how they can access, how they can essentially get their sustainability house in order and access some of these financing, because there is a win-win-win situation that you can possibly achieve. In terms of the process itself, of course, it is an involved process to be able to start from sort of measuring where you are, evaluating what kind of interventions that you can come up with, coming up with targets, and then of course doing all of the work on both the environmental and the social side. I think the social, especially in our sector, was a law very difficult to do. There isn't, for example, a road project stretches hundreds of kilometers. There isn't even proper data on who owned the land, when it was transferred, who was he paid, adequately compensated, and all of that. So we've had to put in a lot of effort and build a lot of skill in being able to compile this, analyze this, be able to present this to investors such as IFC, to be able to sort of access their financing. So I think it will have some amount of preparatory work, but once you do that, I think it solves other issues for you as well. And as far as the specifics of the issuance goes, I think yes, of course, if you prepared with your KPIs, if you know where you're going, then obviously you need to align with your lender, get a second opinion done, and then you're good to go, right? It's not very different from a traditional bond issuance where you anyways have to align with the lender on terms and things like that. But the amount of preparatory work that you need to do to be able to measure and deliver on your ESG goals will be a sort of multi-year effort, but will have to, I think I think it's prudent for people to choose that because, as I said, it diversifies your risks.
Very interesting. I think so. So then, should logically we assume that going forward, this could become a major basket of the borrowing plan? Because obviously, I'm sure Q will continue to grow its invent. You'll obviously continue. So do we
Yeah,
kind
so
of
I think, yeah, in a sense, our goals are now there. What we've done is a very long-term financing. It's a 19-year financing that we've done. So this financing is going to be there. Our targets are there for the world. And we will keep working towards these things. So, of course, in the future, it keeps the door open if there are opportunities for us to borrow through a sustainability-linked financing. We will certainly tap that. We will, of course, be pragmatic and compare it with traditional channels as well. And if it's competitive and if they're there and we have, I mean, and there are opportunities, as I said, for us to specifically borrow for these purposes, we will certainly do it.
great? This is encouraging. Makkar sir, same question to you. You also spoke about the metrics and the KPIs and all. How easy or difficult are these KPIs? I mean, does the lender talk about, or it's a joint collaboration between the issuer and the lender that these KPIs are decided and fixed and monitored? Number two, does at any stage does reporting on the KPIs feel more like a compliance burden, because there's a lot of thought outside that all these things more are compliance driven rather than the actual value. So while we heard Vinay speak about the profitability angle, the indirect benefits that all this was bringing. So let's hear your views on this.
See, it's a very wide spectrum. We need to keep that in mind. Emergence of sustainability practices in Indian industry, if you see, a word has kind of caught up as a buzz for quite some time now. But if you look at fundamentally, any sustainable practices you do in any type of industry, and more so in manufacturing, what Vinay was saying, that it adds to your EBITDA or it adds to your bottom line, which is very, very clear. If you look at any of the exercises which you do to reduce your scope 1 and scope 2 emissions, more particularly, the advantage is really cost. You end up saving, be it renewable energy, be it biomass fuel, be it generation of thermal energy or storage of thermal energy, or water storage, water consumption, water conservation. All these practices which are part of the UN SDGs and they end up giving you advantage on your bottom line for sure. So why would industry not adopt them and at the same time use those practices to avail the sustainability linked loans or any sustainable finance available, which is comparatively better. I won't say it is the best at this point in time, but yes, it is better than the traditional funding available in the market. Now, as far as the compliance part is concerned, I think compliance is far simpler than the initial qualification. The details which are required to satisfy the lenders in terms of especially the large ones, we've been working with some others as well. The data requirement and the data required in a particular format with the kind of trends and history data required sometimes can be a pain in the neck. But then I think it's still worth it because you know what the biggest advantage of for complying to any standard or complying to any norm is that you end up learning a lot of stuff in that process. When you look at your own trends, which you are normally not looking at on day-to-day basis, you realize, oh, I had a blip here. So that gives you a sense that yes, I need more analysis on that. And that helps you. So I see it as very positive. Yes, there are opportunities where some procedures can be further fine-tuned and simplified, which is understandable. And I think that will happen as more and more people start practicing. But you know, I'm not focusing only on large industries. BSI 1000, if you look at, yes, there are systems, there are procedures, there is data, there is analysis. It is understandable. But I'm more concerned about the MSMEs. Will they be able to do it? So it is at that point where they need comparatively simpler, rather much simpler practices and much simpler compliance requirement, where we can encourage the MSMEs. See, today, if you look at the 45% of manufacturing GDP comes from your MSMEs. And those 45% of partners and participants are really not there. They're still being, I would not say, I don't know how to use that word, but they're still being faced with the similar financing available from the normal banks and at the rates which are unimaginable. And then what kind of practices will need to be brought in to get the MSME up to really see the advantage of sustainable practices coming in that sector and improving the overall emissions for the country. We definitely will look forward for that. And these are, as Vinay said, are all long-term loans. And, the kind of investment we are planning right now, they're more again focused on the green mobility. So we will definitely continue to explore these options for wherever the borrowings are required. And if available at a good cost, good price, why not? We continue to look at it. Compliances are part of life. I mean, you will have to do it, for there are always some pain for any gain. So that's understandable.
I mean, you should be,
Your voice is not coming, Swati.
sorry, my voice, okay. This is better now?
Yeah, better. Yeah.
What I'm saying, if as an issuer, the benefits are far outstripping the compliances or the cost of raising this, or for that matter, the extra paperwork involved, then obviously we have a winner in our hands. And then why only IFC? I think this should encourage a lot of our Indian domestic institutions to actually improve their capital towards this. So in that notion, let's go to Mahendra. Mahendra, how do you, we also have a lack of green taxonomy, right? More was expected, but I guess it's still under process. How do you go about choosing? You did mention about, certain segments, but could you elaborate more in terms of, how do you choose? Do you really have to, do you have a clear definition, which is the fund's own definition of choosing green or sustainable projects? Or do you go by some kind of an international convention, given that you would have international capital providers, etc.? And what are your kind of monitoring and reporting? Would you relax it a little bit? Let's say these MSMEs come up, would you relax it a little bit in terms of, as a lender?
No, you're right. I think the absence of well-established taxonomy is frankly a challenge. But you're also right in saying that considering the fact that a lot of the capital that's coming in is offshore, what we have frankly done is we have adopted some of the international standards that exist. So EAAA Alternatives is a signatory to the UNPRI, and we follow the procedures and policies laid out therein. Most of our funds in the real assets front are also SFDR Article 8 compliant funds, and we follow the guidelines outlined there. A lot of the sort of approaches or policies that we have draws a lot from the policies and procedures followed by IFC and multilateral institutions of the likes. So ultimately, absolutely, the adaptation has happened based on the well-regarded or accepted policies and procedures that exist. Now, the second part of your question around how do we approach this for MSME? It's a very valid question. And I think the way we approach this is that we consider ourselves effectively as a translator between what a provider of capital requires and what a receiver of capital is able to provide. And therefore, we have dedicated individuals within our organization as part of EAAA Alternatives who are ESG specialists in that sense. And our role as an investor is that whichever entity we are associated with, we build up the capabilities within those organizations through the resources that we have available with ourselves. So these are individuals who get involved right from the time we are looking at evaluating, any investment opportunity. And therefore, they decide and figure out what are the sort of weaknesses and strengths of the business that we are looking to invest in. And when we do go ahead and invest in those, there is a plan drawn up which covers short, medium, and long term, during which period these ESG specialists, work together with these companies and businesses to strengthen their capabilities on this front. And part of it is the regular reporting capabilities and tracking capabilities. And they are able to also bring in sort of their best knowledge that they may have from other instances where these things have been rolled out, and therefore they're able to do it a little more efficiently. So what we have tried to do is build in these capabilities within our organization and use that or leverage that to strengthen the businesses that we back. And the ultimate objective is by the time we exit our investments, because we are ultimately limited life funds and at some stage we will need to get out, the organizations or businesses that we back are then self-sufficient to continue on the framework that has been implemented. And therefore, if tomorrow there is a different pool of capital with similar requirements that's available, they should be able to access that. So that's been our approach in that front.
Interesting. I think that looks, appears, or sounds good from that perspective. And I think this is an evolving area as more and more entities, come up with more of these loans. I think the market is only going to mature.
Absolutely.
But the point is very valid, which was raised by Mr. Makkar and yourself too. I think ultimately the flow of capital has to happen with the MSMEs if we really have to make a huge dent or you make a huge impact in this whole sustainability journey. Anyway, I'll quickly move to Anjalee now. You've been in the financial services, right? And I've been wanting to ask that how do you see there's a lot of demand, and I think Kedar's presentation also spoke about the incentives and the CRRs and there's a lot of things that include green as part of PSL. And lower the risk weightages and all, to kind of promote green projects or green finance or sustainability finance. Now that you are an independent consultant, maybe you can give us a view on, are you for it, against it, or what's your take on this whole controversy or demand for special incentives?
Sure. I think the first starting point is we need a green taxonomy, and this is something that, our panelists have also alluded to. With the green taxonomy in place, at that point in time, at least the financial institutions will be able to better estimate their green asset ratios. And the second one, again, we have to, before we talk about any incentives and any concessions, we have to accept the fact that the greenium does not exist in India. The third is we need more market instruments like blended finance, climate resilient bonds, and increased disclosures on physical risks by financial institutions, because that will go a long way in helping to channelize this funding. But we have to look beyond asking for the typical ask of the PSL, the CRR, the risk weights, because these have been examined by the RBI earlier on. I think there's been some new initiatives that are something that we need to look forward to. For instance, the Niti Aayog has been exploring the feasibility of having a national green financing bank for India. I think today's news also, the Minister of Renewable Energy has suggested that banks should have what we call as renewable energy finance obligations. Now, these will be akin to the renewable purchase obligations that distributors have. This is largely being pushed because if we are to meet our 2030 target of 500 gigawatts of renewable energy, they are saying we need an incremental funding of 30 lakh crores. But several banks already have pledged to support the renewable sector under what we call as these Shapat Patras. And I think that is a better option rather than having a hard mandate to lend to particular sectors. And lastly, I think we need a lot more of funding in startups where there is a lot more of innovation in technologies. Now, the reason why central banks are taking a little bit of a different stance is what we got to accept that globally there has been a change in the political milieu. And the new thinking is that central banks should be perceived as being market neutral rather than encouraging or discouraging credit to select sectors. So some global central banks have articulated that their mandate is price stability and growth, and they don't want to be perceived as interfering in free markets. Now, this has been a stance adopted by the Swiss National Bank, the Federal Bank, and even as recently, the European Central Bank. So I think the RBI is taking a mid path. They will wait for the green taxonomy to come before coming out with some of these recommendations.
This is interesting. While I completely agree that the taxonomy is the first step, but at the same time, what you said makes a lot of sense in terms of how the RBI or how the regulators would approach that, and I'm sure the Indian regulators are going to be looking at it, and probably that's the reason why some of these things are taking its own time.
And the best way forward is that all this becomes mainstream financing.
Yes.
So we don't look at it in two separate buckets, but we take it as business as usual going forward.
Yeah. And I think the fact that, and which is what I thought I'll ask Vinay, but I think this is going into an interesting area, but we have also a lot of questions. So my last question is to Vinay. Vinay, the country needs huge infrastructure, and you've shown how sustainability can go along with infrastructure, because obviously mostly infrastructure is associated with a brown thing. So I just wanted to know, we also wanted to know that do you think that climate related risks, have they in a way impacted the costs negatively also because of the frequent roads, or the floods, or the frequent the heat waves, etc.? Would that have led to higher maintenance costs, etc.? Or do you see some kind of changes in the cost economics around that?
No, I don't think there's a trend here as yet, but we're obviously we're evaluating it. We keep monitoring as to how our maintenance costs are sort of moving year on year. And if there is an impact on account of sort of climate related events, of course, uh, flood events, we've had a few in the last, I mean, over the last 10 years. And I think different floods have impacted different parts of the country. And depending on where your assets are, you could be impacted or not. This year, Kerala had a very bad incident, for example. A few years back, Tamil Nadu had, and so on and so forth. So I think I don't think we have a trend around this. But yeah, but we're I think certainly one of the heat and peak heat is a concern. Because it could potentially sort of have an impact on the quality of road surfaces. We've not had those issues. In any case, we've designed our roads to be resilient to some of these things. So we've used polymer modified bitumen wherever we've used our highway, so that it's capable of performing well even at high temperatures. But yeah, but it is I think certainly a topic that we evaluate continue
Absolutely.
going forward. Yeah.
Great. I think I'd like to now move into questions because we do have some decent questions, and we are reaching towards the end. Yeah, okay, just give me a second to get myself organized on this. Yeah, the first question is to JK. JK Group. The question is, in addition to scope 1 and scope 2 emissions, what are the KPIs considered under a sustainability linked loan? And given that the waste management and resource efficiency are key issues, how are these factors integrated into the KPI framework?
Okay, the two KPIs which are first obviously is the scope 1, scope 2 reduction, and the second KPI is related to water. We as a country are water stressed already, and two of our locations are on water stressed areas. So we took water conservation as a major sustainable action plan. These are all linked in with each plant's water conservation efficiencies. Similarly, all the GHG emissions related to all the plants, there have been energy conservation projects which have been identified, and a detailed planning has been done for our SBP planning, which is strategic business planning. And also, we are a certified SBTi target validated. So we are planning in line with SBTi as well. And also, as a company, we have committed towards 2050 net zero. So we are working towards that as well. So it's a complete platform which we have developed, and the KPIs are linked with each action at the plant level and even at the equipment level for energy monitoring and energy improvements.
Great. I hope that satisfied the question asked by the gentleman. My next question is to Anjali. Anjali, this is a little global. How does the US withdrawal from the Paris Agreement impact ESG investments in India?
I think there is a little bit of an overreaction that has come in. Remember Trump 1.0, they also withdrew from the Paris Alliance. Now, what statistics show during that period of time, we've actually seen in the US, there has been an increase in renewable energy. So I think people will go by commercial decisions and they will go by basic what risk management is telling them to do. So even though you've seen a large number of banks, for instance, also having withdrawn from these global alliances, these net zero global alliances, the reality is when you go and look on their final statements, they are all saying, while we've withdrawn from this, we remain committed to our net zero targets. So there will be a little bit of noise, there will be a little bit of different perceptions, but ultimately, I think all countries will go down the path that is required. Maybe there'll be different terminologies to be used, but I think there is also a little bit of rationalization that has come in, because we used to have a large number of shareholders that were coming in with these very, very strong mandates on ESG without understanding the country nuances. I think that has settled well. The other thing for India, I think when we've taken a target of 2070, in this environment, we probably look like we had a realistic target, though we had a lot of flack for giving the 2070 target when everybody else was aligned to 2050. But ultimately, countries have to be able to do it based on what is right for themselves. India is going to run a two parallel energy system with fossil fuel as well as growing renewable energy because the demand for energy is just increasing.
No, very interesting, and I agree. I'll move on to the next one, which is for you, Mahendra. Can you touch upon the ROI factor in your sustainable investments?
I'm not sure what that question is referring to, but if it's about what sort of returns we are targeting, I think it's pretty clear that from the investor's perspective, there really is no differential in the investments being made. I think the only difference is that there is a wider pool of capital that's available. So frankly, renewables in India is a classic example and is touted as one of the big success stories. And the reason renewables is a success story is because today renewables is competitive on its own, and investors are able to make sort of competitive returns, while at the same time the sector providing sort of climate-friendly solutions to the energy system. So I think from investors' perspective, the idea is to sort of look at investment opportunities that give you competitive returns, while at the same time addressing some of the climate concerns that we are facing. So I think that hopefully that addresses the query.
No, right. And I think during the session itself also, the speakers and everybody had made it clear that, there's no greenium, and based on the risk reward, it's to be evaluated by like any other typical investment. So my last question to you, Vinay, is that, road sector is perceived to be a green, it's perceived to be challenging to classify road assets as green. And what, according to you, an issuer has to do to address potential concerns against greenwashing? Do you think that this kind of classification will be useful for wherever sectors, wherever green is green classification is still evolving?
No, I think yeah, as Mr. Makkar said, manufacturing infrastructure, of course, are not green, but you can't do away with it, and therefore there are opportunities for us to be more efficient, be more use resources in a more optimized manner. A case in point is one of our roads. When we took over, the quality of the road was quite poor. Typically, when you have poor road, the old practice was mill, which is to remove the layer, throw it away, and then put a fresh layer. Right? When it's really bad, that's what you do. Right? The net effect is that you pay money to dispose. Bitumen is obviously is environmentally not friendly. You need fresh material, which again is both cost and environmentally not friendly. In the past, we had done some recycling where we'd done something for maintenance purposes, maybe 20,000 metric tons, things like that. But here it's a very long road. It's a 100+ kilometer road, and we had to do the entire thing. Almost 400,000 tons of material, so 20 times the size that we are dealing with. So we worked with IIT Madras, we worked with L&T, we worked with an American company called Ingenuity, and designed a process where we were able to recycle the material without heating. So it's a cold central plant-based recycling process. So you mill it, take it, add some emulsions, and come back and lay it again, right? So we ended up saving commercially about 30 to 40% of the cost because we didn't use virgin material. It possibly allowed us to acquire the asset because we were competitive in that bid because we were able to underwrite a new technology here. It saved almost 80,000 tons of carbon. We are in the process of registering voluntarily for carbon savings there. And while doing it, we between us and L&T, we got so good at it that we created a world record in terms of the most amount of road laid within 100 hours, 100 continuous hours. We did 112 kilometers. So that's sort of this is the example of how essentially if when you go into the nitty-gritty and you plan well, you can essentially bring in a lot of efficiencies into how you perform your what is otherwise not a very green business. Yeah.
Very interesting. And I think there's a lot of takeaways from this session today, at least for me, and I'm sure my team. One is, of course, there is a lot of potential and a lot of issues, and I hope the country, this means of finance, kind of develops in the real intent and the real uh, manner in which it is. And there are enough of issues, there are enough of projects beyond the renewable energy to, kind of have takers, and therefore there are lenders. Um, with this, I'll hand it over back to Mamta. And before I do that, let me thank you all. Great panelists, great discussion, and thank you for the lovely audience for keying your questions. And if there are any specific questions, rest be assured we will forward that to the specific speaker and try to get a specific answer for you. And over to you now, Mamta. And thank you once again, the panelists and the audience.
Thank you, Swati, for moderating the session and Kedar for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now, requesting the tech team to kindly log off.